All right, everybody. In this video, I'm going to go over my option trades that I previously did, the data that I look at in order to decide if I'm going to make an option purchase, and these are all in selling covered calls, possible outcomes that I've already received for a few, and just general strategies that I've been following that might be helpful for you as well. So I made a spreadsheet here with the stock name, all of these individual companies. I own over 100 shares of stock, and I've been selling covered calls. That means that I am receiving a premium for selling the call option. If it hits to that strike price, then I would have to sell my 100 shares at that strike price. So I'm writing down the date I sold the call, the date of expiration. Some of these were 1 month out. A few of these were 2 months out here. Right now, the stock price when I actually sold the call, so it's the current price when I make the decision. These are the strike prices, the price that I'm looking at selling 100 shares if it hits that price. Notice that all of these are quite a bit higher from the price that I sold it at. The percent above current is essentially this minus this divided by the original again. So you notice that most of my percent above current are at least 10% higher. The premium is the money that I receive from making the trade. So these are all in dollar amounts. Delta has to do with the predicted percentage. It's not going to be exactly this percent every time, but predicted percentage of if the price will go to that strike price or not. So if you have a delta of 50, that means that there's a 50% chance that the price will hit the strike price. If the delta is lower than 50, then it's unlikely to be exercised. It'll be less than 50%, whatever the number is. So if some of these deltas are about 20, then there's a 20% chance that it'll hit that price or not. And then I wrote the outcome. So if I go to my account activity, here I show my settlement dates, the name. These are all sell to open. That means I'm starting the covered call process. It shows the price and the amount that I received. So let's go over the trades. First one was with Realty Income last month on the 16th. I made it for expiring on Friday. It was 63.16, but I made a strike price of 70, so that's a 10% increase. If Realty got to 70, I would have to sell 100 shares. 70 times 100 is $7,000 that I would actually receive back in my brokerage. So I wouldn't be that mad if that happened because that'd be a 10.8% gain in just 1 month. I don't want to necessarily lose my 100 shares of Realty, so that's why I made a pretty high percentage above it. The premium was pretty good at $59, so I received $59 immediately in my brokerage for doing this. The delta was about 20. I didn't actually track deltas until recently, and I'll go over a website that shows that for you. I noticed that the stock price of Realty actually went lower than 63. It was in the 50s. At 7:06, I decided to buy the call, so I completely closed out the position, not to worry about the 70 anymore. And I bought the call for only $6. So I made $59. I spent $6. That's a $53 gain, and only 16:06, about 20 days or so. So it's a pretty good gain. Main Street Capital, same date, same expiration. It was $33.89 at the price. I sold it for $40, which is a pretty big jump, or about 18%. So very unlikely it's going to happen. And the delta is about 10, so about a 10% chance that I'll actually reach 40. And again, if it reaches 40, I'm still pretty happy because I made an 18% gain on 100 shares in a month. I only received $19 in premium on that one, so pretty small. And then I waited until yesterday when it actually closed the position. So just $19 in that gain, 100% gain on that purchase. Newt is, again, 619 decided to do one for 2 months out. It's a 1753, sold the strike at 20. It is paying a dividend in between that, so the dividend is going to be pretty high. It's about 3.5%, I think, coming up in the I think middle of August or so. So that's going to possibly affect the actual price of the call. It probably will be going lower by about 3% or so with the dividend is right before it. So it was 12% above. Did receive $59 premium. Delta was a little bit higher though, 30% chance that they might hit that. And I don't know the outcome yet because it's currently going. Right now, the premium to buy it is about $25. So I could close the position for $25 and then make 59 minus 25 in the position. For Realty, I bought the call on July 6th. And then that was essentially the same date that I sold a new call on Realty for expiring end of next month. It was 61.10. Notice it went down a little bit from June. I sold the strike price a little bit lower, 67.50, so 9% increase. Premium was high on that one, $94. Also was a little bit higher since my strike price is a little lower, so it's about a 35% chance this might happen. Next PhD was the last one I did, 7/13. The expiration is 9/18, so 2 months out. It was 32.58. My strike price is only 35. That's 7.4% above the current price. So this one I'm being a little bit riskier on if the calls might get shared. So it's still 30. So it's a relatively unlikely to happen, but it still could. And I received a $54 premium. So all these outcomes, I'm going to write down what happened. These are still open positions, so I don't know yet. Here's one way to find the deltas, again, the approximate percentages, and this will be a link in the description. Go to cboe.com, and then you can just type in your quote. So let's say I own AT&T stock. You go to option chain. I usually do options of all, so I can see all the different possibilities. Right now it's July 18th, so let's say we're looking a month down in August. Do chain. Last was 30.26, so if we're going to sell a call around 33 or so, so it's about a 10% strike price over the original price, you would make between 0.11 to 0.18, so between $11 and $18. You could definitely make $11 if you put that in, because that's what the bid price is. The ask price is the other side of the table, is 18. If I was doing this possible trade, I'd probably put it at 15 or so, somewhere in the middle. So there's a pretty good chance it'll be exercised. $15 is not the end of the world, but the delta, that's the percent chance of it actually hitting the strike, is only 13%. So it's very unlikely AT&T stock will go up $3 in just a month. So definitely look at the different situations. I would recommend, if it's a stock that you don't really want anymore, if you already have 100 shares, don't necessarily sell it at the current price. But if you don't think it's going to go down way more and it might just hover around there, try to sell a covered call at the money. Let's say I didn't really want AT&T anymore. I might sell a call at, say, 31 or so. 31, you would get a bigger premium, at least $54. The delta is 38% though, so a little less than 50% chance that it might expire. But if you're going to sell it at that price anyway, you'll be pretty happy because it gained a little bit. If it doesn't hit 31, you still made a much higher premium. So definitely look at the different numbers about what might be a better possibility for you. Like, subscribe, hit the smash button, all that good stuff. If you have any questions, feel free to let me know. I'm always available. I respond to every comment that I get. And I'll see you guys next time. How's it going?